The S&P has had a record drop. The S&P has broken through new highs. The sky is falling. No, wait, it's not. Continuing with our series on investing, in this video, the second in our series, we're going to discuss some more fundamentals on investing, namely risk, or its technical term, volatility. Hello to all you financial people out there, and welcome to Just the Tax, my little channel about spreading the good word of financial literacy. So it's more than just the tax. Also, quick shout out to all the folks out there at the Collegiate Financial Management Association's University of Maryland College Park chapter. Go Terps! I'm making these videos because this is stuff I wish someone would have told me about back when I was first starting out. And again, today we're going to talk about risk, or its technical term, volatility. First, let's define some terms. What is risk? Well, it's the chance you'll lose something, but it's also the chance that you could gain something. See, it's all about our emotions. We fear losing even a small amount more than we want to gain something. This is hardwired into us. This is where the emotions come in, the whole fear and greed thing. It's necessary, though. Without risk, there will be no chance to gain. In other words, that old saying, nothing ventured, nothing gained. So we need some risk. What is volatility? Well, it's the technical term for risk, but it's more than just that. Volatility measures the magnitude of price changes and the magnitude of trading volume, meaning how many players are in a given part of the market at a given time. What is beta? Beta is a given stock's volatility versus the overall market's volatility, and it's expressed as a number. Beta should correlate with the return that you're going to get on that investment. For example, let's say you put your money in a bank CD. Well, those have very low risk, therefore they pay a lower interest rate. So you want to make sure that if you're invested in something, the beta or risk that you could lose that money is not so high relative to the amount you could earn off of that investment. They want to be correlated. So ideally, you'd want to have very low beta for high return, but that doesn't really exist in reality. That's the whole if it's too good to be true, it usually is. Steps to manage risk. Know thyself, right? This thing we said in the very first video in the series. You can go to Google and type in risk tolerance questionnaire, and you'll get a lot of results that'll come up. And these should be free to use with no obligations. Make sure that they're trustworthy sources. And basically you take a survey, it's a short survey, and it gives you an idea of what your tolerance for risk is. And again, calling back to the first video in the series, you don't want to assume anything. So for example, I had an elderly client who you would think would be very risk averse, but it turns out that that person could handle the risk. On the other side, I had a client who was very young. You would think they would have an appetite for the risk, and it turns out they had a lot of adversity to risk. So you want to don't assume anything, know yourself, take the survey, get your number. The next thing to know about risk is something called dollar cost averaging. You can't time the market. You can't, so don't even try.
No, you can't. Don't even try.
Yes, thank you, Will Riker. In other words, dollar cost averaging says that small but consistent investments over time yield better results than a single lump sum purchase. So it's better, like let's say you're going to contribute $5,000 to an IRA over the course of the year. It's better to divide that 5,000 into 12 and put that amount in each month than to just wait till the end of the year and put the whole thing in at once. And that's something that holds true over the long haul. This little bit of wisdom comes from the book Simple Wealth, Inevitable Wealth by Nick Murray. We mentioned him in the first video in the series, and we're going to keep talking about that. Next thing is you want to cultivate a mindset that we live in a world of risk, of volatility. So don't shy away from it, be mindful of it, and understand its use in your portfolio. Again, calling back to the book Simple Wealth, Inevitable Wealth by Nick Murray, he says, optimism is the only realism. So what does he mean by that? Well, here's what he means. Even with the Great Depression, the 1987 stock market crash, the dot-com crash in the 90s, the global banking crisis in the 2000 aughts, and our current times, that the market ultimately, over the long run, trends upwards. So therefore, your greatest risk is not participating, but do so with a plan and knowledge. So how can you get started now? Well, again, commit to learning, read books and articles from trusted sources, avoid get-rich-quick schemes. If it sounds too good to be true, it usually is. Practice paper trading before you put actual money down. Build a habit, cultivate the right mindset. Make sure you set aside money in a rainy day fund and max out your retirement plan, at least enough to get the employer match. And then understand the purpose of risk, what it's for. It's a tool, and understand your own natural tolerance and build this into your investing strategy. There's no right or wrong. There's only what's right for you. All right, my fellow financial people, thank you for watching this video. Please like, share, and subscribe. And in the comments below, post some requests for topics you'd like me to cover in future videos. In the meantime, may your profits be high, your taxes low, and I'll see you next time back at Just the Tax.